Cool. Hi, everybody. Welcome to the webinar. We're really excited to have everybody. For a quick kickoff and housekeeping, as folks are trickling in, we are going to be on for roughly 45 minutes. Have an amazing panel here with Eric, Kyle, and Alex. It's a webinar where we're going to be talking a lot about audits for high growth startups. So it should be really interesting. We'll start with a quick round of introductions for everybody, and then dive into some questions that I prepared for the panel here. We'll hopefully open it up for Q&A as well then shortly. As you have questions along the way, feel free to post them in the chat. We have Stephen here and myself that are monitoring the chat, and we'll be able to help answer these on the fly. So with that, I'll jump in. Yeah, welcome. So we'll be talking about audits here. We have a fantastic panel, as I said. It's a webinar that's brought to you by Rillet and Moss Adams around audits and audits for high growth startups. So number one from Moss Adams actually themselves, we have Kyle here, who's been a really experienced auditor, has spent 2 decades in public accounting. So I always kind of think of it, if you can think it, he's probably seen it. So ask your questions, you'll have a ton of insight there. Very much focused on life sciences and technology companies, particularly venture-backed startups. And he's also a member of the firm's SEC practices committee and has helped with many IPO filings and consults with technical accounting. So a true expert here, accompanied by Eric, Eric Meyer, who's the SVP of Finance at Blackthorn. He's a veteran of startups as well, has seen a bunch of things. He's gone through multiple acquisitions, one of them even to Microsoft as well. He's an accountant by trade, so actively holds his CPA. He's also a Rillet customer, so thank you for your early trust there, Eric. One of the reasons, again, why we're so excited here with both Eric and Kyle is that they've worked together for many years, and we'll have some interesting stories to share there. And then lastly, from Alex as well. She's been an auditor at PwC for quite some time and specialized basically in auditing high-tech companies. So we'll have a great panel here. Excited to get started. Welcome. So with that intro, we'll start slowly, guys. So I would love to start maybe with you, Kyle, by asking you, when does a company know that they're ready for a first audit? What are sort of the catalysts?
Yeah, awesome. Well, yeah, first, thanks for having me. Super excited to be here, Nick. Yeah, so maybe I'll back up even further. Kind of when is an audit required? Like what triggers an audit requirement? So typically it's three reasons. Really, it's investors. Typically will kick in and say, hey, companies raised enough capital, requires a financial statement audit. So it varies via the investor group, but oftentimes, kind of Series A, Series B, kind of that phase where a VC company will say, hey, the company needs to go out and get an audit. Two, if the bank, right? So if there's some debt outstanding or a line of credit, the bank will often require a financial statement audit. Or three, if the company's looking to potentially maybe never been audited, looking to potentially sell and go through a transaction, they'll want to have expecting some diligence, and a diligent item might require a financial statement audit as well. So those are probably the three kind of main triggers for an audit. And so like to answer then your question on when's a company ready, so it's really a progression, right? So I think when a company truly is ready, is I kind of break it down as is their trial balance, is their financial statements, GAAP compliant? So have they, went from either, if they're not on accrual basis of accounting, right, getting to accrual basis, but also just any sort of adjustments to the trial balance, right, have been made. So that's one. Two, just policies that support any sort of those adjustments, making sure you have the right documentation in place. And then I would say the last one, just really, is the company have the capacity and the timing to support an audit, really? So there's a lot of work for those that have been through audits. Eric can attest to this, but just making sure that they have the bandwidth to be able to support the requests and the sample selections and so forth. So that's usually, and it's a progression to kind of get ready for an audit, which we'll dive in further.
Yeah. Awesome, cool. And after the first question, I'm already taking you guys off script. So we'd love to ask you, based off Kyle's answer just now, Eric, just give us the other side of that, basically, internally. How much did you practically see actually at Blackthorn or other companies that you've worked at that you were truly ready, you had some of these policies in place? the financial statements that you were talking about, or was it actually potentially other triggers, or yeah, how did that side look like from your end, basically?
Yeah, I would kind of echo what Kyle said. Our starting point is when is an audit required? Generally it's with an investment round, a bank agreement. So from a starting point internally at high growth tech companies, we're not running to the front of the line to do an audit. It's generally when it's required. From an audit readiness perspective, I've seen variations. I think a baseline is having the core financials GAAP ready. Where sometimes early stage companies don't have everything lined up for that first audit is on some of the documentation. Often when an audit takes place, there's things that we realize, we could have been more ready. And I think each time going through an audit, you learn and you get further ready for the next audit.
That makes sense. And then assume you're starting to realize that, again, these external triggers are happening. You're starting to become ready. Maybe a follow-up question there for you, Eric. How do you pick your auditor? What is the starting point?
Yeah, that's a good question. We generally would look at firms that have experience with companies at our stage. So often, I've joined companies where it's Series A, sometimes bootstrapped, sometimes Series B, generally earlier stage, but growing with aspirations to grow. So we look for an auditor that has familiarity with companies that look similar to us, but also are big enough to grow with us as we've gone. You mentioned earlier on the call, I've done quite a bit of work in the past with Moss Adams. They've been flexible with us, early to know that we may have a small lean accounting team and there may be some control issues that we just can't get around based on the size. But then as we grow and get further financing and eventually to acquisition, there's a big enough team. So we kind of look for flexible but scalable.
Oh, awesome. And maybe continuing on sort of that sort of phase where we're taking people through the journey before things actually kick off. There's a great and tactical question here in the chat by Alex. Once you realize that you're going through a first audit, what are lead times to in that DD process on who you're picking, from sort of realization to signature? How long does that take usually, and what are the process steps there basically that either of you would recommend to run through?
Yeah. For me, I think it's starting as early as possible. So, I mean, I currently right now I'm going through kind of the readiness assessment for first year audits for 2024 audits, but in some of them we're already talking about 2025, right? I do think starting as early as possible because there is an additional balance sheet that's involved with it, right? You have to kind of have a clean cutoff, and there's the readiness assessment that needs to happen. So I do think having those discussions early as possible. The start to stop timeline, it really varies. I mean, if the first year audits are challenging, right? I think for those that went through them, I mean, know that they can be really challenging and the timeline can extend. So it's about getting through the gap, I call it the gap readiness assessment, in advance of the audit. Because if you don't tackle some of these big ticket items in advance, it could extend the runway, and pretty soon you can start your field work in May and not be issuing until December or January the next year. And that just becomes really disruptive because everyone's wearing multiple hats and that's a lot on their plate. So again, I start the process early and start in really working through those, big ticket items, the readiness items in advance is super helpful. And we kind of have some tools that we work with our companies on to kind of identify them. And we, work with a lot of tech companies. We kind of know the usual suspects and can kind of work with the company and collaborate on who's doing what to be able to kind of get ready for field work essentially, and to be able to kind of jump right into the audit, if that makes sense.
Yeah. And I would add on that kind of readiness. I found it helpful to have a certain level of transparency with the board. If you've raised money and you've got somebody from, on the board, just keeping them in the loop on the process of how you're going about selecting an auditor, what timelines look like. And that can often alleviate some of the, a bad spot to get in is where you've got a really compressed timeline to do a first year audit. That can create unnecessary stress. So I think having a level of transparency with your investors and the board is helpful.
Yeah. And very jumping in quickly, just very tactically for folks that are contemplating actively. So I heard you kind of throw out an implicit timeline of half a year, Kyle. Like, what is sort of the shortest you've ever done, and what is sort of the
Yeah.
median and then longest, so people have a sense?
Totally. That's a really good question. I would say quickest is you're looking probably 3 months. I mean, 2 to 3 months, because I mean, you would have to already be to your policies kind of already documented, feel like you're already gap compliant in your books, and then jump into field work and then subsequently reporting and issuance, right? So you got to think once you start field work, we try to issue the financial statements within, ideally a month after final field work, right? Several weeks at times. So you got to look at 2 to 3 months, but then probably 4 to 6 is more of a safer bet. And typically we schedule, like we're talking right now, May, June is kind of when we typically will do kind of if we're bringing in new audit clients for 2024, this is the time that, gives 2 to 3 months to kind of go through the readiness items, do the final field work and issue the statements by end of June is kind of a realistic timeline. But if things don't go well and things aren't ready and the documentation isn't there and the adjustments haven't been made, that could slide through the summer, and then you get in the fall and then you're issuing statements at the end of the year. So it's really across the gamut, and it really depends on how well the readiness and sticking to the timeline.
Yep, that makes sense. Alex, Eric, anything?
Yeah,
Anything
layering on there, I think understanding what your business's busiest times are will help also with the pacing of the audit. So if you know you're going to be really busy in March, maybe don't kick off the audit in March, maybe wait until the summer. And then also understanding the capacity of the firm itself. So if the firm knows that they're going to be really busy in June, you might not want to kick off until a different time. So being transparent about busyness levels on both sides of the relationship can really benefit speed of the audit itself.
I agree. The honesty and just being transparent and teaming and working together through it, right? Because everyone gets busy with schedules and so forth, and again, the bandwidth is a concern at all times, right? With the people wearing, especially in tech companies, emerging growth companies, are wearing multiple hats and doing different things. So it's not just going to be fully supporting a financial statement audit, because you're doing a lot of other things for the business. So it's working together, and we try to be as collaborative as possible. At the same time, being realistic, and if things aren't ready, we're flexible to kind of move things as needed, but at the same time wanting to stick to a timeline. And we got some great project managers on our team as well that kind of can work through whatever the deadline is that we're trying to hit.
Yeah. And I'd love to, since we have, again, you as a sort of pair here, Eric and Kyle, having gone through audits together multiple times, what are sort of the, what do you, maybe starting with you, Eric, what do you appreciate in Kyle, or like again, trusted partner when you go through your audits? I've heard you say before, like, again, trusted partner, that like literally these words, but yeah, maybe help people like kind of at an interpersonal level feel out what's important, and how do you build that trust potentially as part of the selection process?
Yeah, as mentioned, I'm an accountant by trade, but I do not have a public accounting background. Nor do I. My main role has been, trying to grow the business, SaaS metrics, EBITDA, words that auditors don't love. But really, I spend a lot of my time focused on the go forward and how do we grow the businesses. I find comfort in being able to reach out to an auditor and go through the list of events that we've gone through the year, whether it be an acquisition or we've raised some money through issuing safe notes. Being able to, these things happened, from an accounting standpoint, what do we need to be thinking about? And that's much better done earlier on in the year versus mid-audit. And these are things that you haven't thought through. So in terms of like, being able to ask for, being able to reach out with questions and just have that kind of pre-planning meeting, and then you can address those issues as needed.
Yep, that makes sense. And that's maybe a perfect segue a little bit. I saw one or even two questions in the chat around like sort of specific areas as you're going through the audit. So like now clicking one level deeper, more technically, maybe passing it off to you, Kyle, like what are like the big items to hit for you guys, and that need to be sort of thought through?
Yeah, totally. Yeah, we kind of have a tool we use. We call it a gap readiness assessment. And really what we found is we see kind of the same type of items typically on a lot of them. Maybe it's not all of them, but there's usually a handful, maybe 2 to 5 items that we need to work through leading up to the financial statement audit field work. And so we always start with revenue recognition. The investors are typically most focused on revenue. The companies focus on revenue growth. So making sure that 606, you're in compliance with 606 from a revenue recognition standpoint. So any sort of deferrals of revenue or timing of revenue differences that need to be made are there. Sometimes, a lot of times with SaaS companies, maybe it seems, it's pretty straightforward, it's a straight line revenue, but there's some nuances typically once you actually get into some of these, there's, unique contracts, whether it's variable consideration or timing of when the SaaS agreement kicks off and starts, or other professional services that set up fees, like little nuances where you might think it's straightforward, but even if it is and there's no adjustment, there still needs to be, I would say, a policy memo or documentation to support that. So we would always start with revenues. That's where we probably spend the most amount of time in our audits. And then I look to kind of the next area is really kind of equity or debt, and really how the kind of company's been financed. Whether preferred stock agreements, is there any warrants outstanding, stock-based compensation. Usually, companies don't record stock comp until they're forced to for the audit, right? Very standard. But kind of getting the software system or whatever the company's going to plan to use up and running, pretty standard. If there's convertible notes, that could be complex, right? So I kind of look at the financing structure. And then lastly, really anything on the balance sheet asset-wise that needs to be capitalized. So whether it's capitalized commissions through the 606 standard, software development costs, leases that need to be put on the balance sheet. So those are I would say those are the areas we work through, and through this, kind of checklist tool, we're kind of working through with the company and deciding, okay, do you have the bandwidth to take this on, or do you need some assistance, whether in outsourcing it to a third party, potentially having us as non-attest services help with some of this if it's over, they don't have the bandwidth or the expertise in certain areas. Again, we try to collaborate and work with the companies. Obviously, there's independent standards and we have to maintain, but at the same time, we want to make sure that we're all after the same goal, which is to, this is an additive process, right? Going through audit, we want to get through the audit, high quality audit, gap statements in the shortest amount of time, really. So we're all after that. So what's the best way to work together through that? And so that's kind of the goal and objective.
Yeah.
No. I was going to say the readiness assessment is a very good kind of like baseline. It is like, are you ready or not? But it also kind of highlights to the company itself, where are our gaps? Where can we fill those before you even start the audit? Do we need to hold off a year? Whatever it might be. So again, echoing like starting the vendor search process like as early as possible, definitely in the best interest of the company, even if you don't have the audit that year that you start the process.
That makes sense. And then thank you. One question that came up in a chat that I want to tie in here a little bit is for smaller companies that are kind of coming off an accounting firm or a bookkeeping firm that then at some point need to prepare for that audit very tactically. I know, Eric, you've had an in-house team for a while. Maybe you have some insight there on how to best manage that transition, or you, Kyle and Alex, like how do you manage that transition from someone that maybe had let me frame it positive, maybe a slightly less bandwidth or knowledge about your company, or frankly, sometimes lower care factor and some of the details of the company for the long term, and then transition that into something that, again, is useful go forward. Anything tactical there that you guys have experienced or can share with the audience?
My approach there would be as if it was done externally. The company needs to almost step in and do a mini audit internally and validate the transactions that were booked to make sure the supporting documentation is all there before going through an audit. So there'd be an extra level of digging there is how I would approach that.
Yeah, it's ultimately the company's financial statements, right? We've done audits kind of every form and fashion, whether it's completely outsourced, whether it's a kind of a hybrid, or if it's just an internal team, and it really just depends on kind of how the company's set up and structured, and really we're just working through, okay, well, where's the bandwidth? Is there any gaps on the technical accounting front that need to be filled, depending on the roles and responsibilities? And sometimes it's just one single person on the company side, right, that we're working with, which obviously they're dealing with some segregation of duties issues, but that's not uncommon. There might be a control comment there, but that's fairly standard for kind of emerging growth companies as well. So we've kind of seen it all, and we just try to kind of be upfront and just kind of set the timelines, set the responsibilities and who's doing what, and just work with the company through it.
Yep, cool. That makes sense. Awesome. Then as a sort of next area that I'd be curious about, maybe for you, Eric, a little bit of like going through, if you remember back your first audits and or also first audits with current companies, what are things that you wish you had done differently? What are things or preconceptions that have changed basically since you've now gone through multiple audits versus when you started?
Yeah, I could speak to kind of the latest experience. First audit, I think that there were, would have spent revenue recognition took up a bulk of the time. So I think we could have, really documenting how the company recognizes revenue. You may have multiple revenue streams, getting really granular on that type of support and documenting that earlier. Second, I would say, at Blackthorn, we've done a good job of, the accounting staff of leveraging technology, the less manual transactions going into the accounting system, generally the more consistent the data. We are a Relit customer. We're going through our first audit with that. I think that will help a lot on the rev rec schedule now that everything's baked into one spot. And then thirdly, I would say one thing it's important is, educating the team on what an audit is. Oftentimes you may have team members that haven't gone through audits, not explaining that there is a common goal, what the end result looks like, and why we're doing the audit. Generally the auditors are not it's not an IRS audit where they're coming in and want to issue a bill at the end of the day. So I think getting the team on board, I think it's really important to educate, here's how the process is going to look, here's the timelines, here's the end result and why it's important.
Yep, that makes sense. And maybe similarly, we'd love to hear from you, Kyle. What are sort of common mistakes that you're seeing as people going through that people here about the call can think of avoiding?
Yeah, for me, I think it's trying to avoid, I call it a false start, right? Like where, okay, you have a deadline and sometimes it's a very firm deadline, but you're working backwards from a deadline. But so you set field work in and things aren't ready, right? There's still things they're working through. And I would say maybe it's the revenue recognition, or maybe it's some sort of where evaluation that needs to be done on whatever, a convertible debt or some sort of other instrument. And that hasn't been completed, but then you start the audit anyways. And so then what ended up happening is you're spending time on the lower risk cycles and, prepaid expenses when at the end of the day, everyone really cares about revenue, right? We're better off to just regroup collectively and say, okay, hey, let's push back things a couple weeks and let's get this all buttoned up and let's focus on the main areas that we know are going to take the time, because if you false start, you're still going to have these other items that are just going to still be outstanding, that are going to the long pole in the tent, for example, that are going to delay or defer potentially issuing the financial statement. So starting early, obviously, but again, just being open and honest and where there is, there's obviously a financial cost to an audit, but I also say there's a human capital cost as well. Like if your team doesn't have the bandwidth, let's be open and honest with it. And yeah, or if and you're going to put a lot of strain on your team, you got to be thinking about that as well, because they're going to be the ones doing all the additional documentation on top of their normal day job. That's going to cause a lot of pain on your team. It might make sense to bring in a third party to support on certain areas, or lean on your audit firm a little bit more. Yeah, it's again balancing the financial cost with the cost and burden of your team, right? So just being open and honest on that is super helpful. And certain times maybe as a partner, I haven't pushed my clients at times to say, hey, you just need to bring somebody in to help, or there's a gap here, we need to get in front of this, and trying to be just transparent and honest about that, right? And work together through it, right?
Yep. And maybe tying one of the audience questions into as a follow-up to what we just went through for you, Kyle and Alex. What are these tactically the most burdensome that you usually see for companies as part of the audience? What are these areas?
Yeah, and it's again that gap rating. I mean, it's a lot of times it's the revenue, equity, debt, and kind of anything they have to capitalize costs that you haven't done, software development costs, kind of commissions, those types of things. So anything that, because oftentimes it's not just an accounting entry that needs to be booked, right? But it's also some sort of analysis that goes schedules or a memo, documentation support to support those entries, right? So again, those are the types of things. And or if there was for example, asset or business combination, those types of things where it's like, hey, we haven't really accounted for that. Well, obviously that involves valuation and so forth, right? Obviously the tax provision and those types of things usually kind of make sure those kind of come maybe sometimes afterwards as part of the reporting phase. But I would say those kind of main areas I just mentioned are the ones that will slow down the process, because yeah, you can do certain things, but it's going to slow down the timeline if they're not addressed. It's best to address them before you start final field work.
Definitely agree there. I think revenue is the biggest one, but also having been on kind of both sides, both audit and also being audited at a company, I totally understand why some of these processes might be overlooked because you're just moving so fast. And so I think auditors are not here to say, hey, you didn't do that. It's not a slap on the wrist at all. It's more so they need that documentation to be able to do their job as well, to ultimately help you to deliver on the audited financial statements. So definitely a time constraint issue for sure, especially at a high growth startup, but that's definitely something just to be aware of while you're prepping for your first audit.
Yeah, awesome. Cool. And I'd love to sort of sequence this out now a little bit in time. So we talked a little about maybe the first audit or the first 2 audits or so forth, but how does the relationship progress over time? And we'd love to touch on both things, like just like on an interpersonal level, like what have you seen being most successful, but also at a very tactical level, how do these areas of focus change and so forth, so people get a bit of a sense for the future, and or they're currently in a relationship with an auditor that they're not sure is the right fit. Like, what does that look like? So multi-part questions here. Maybe we start with the easy one. How does the relationship progress from a sort of a first audit over time? And what focus areas change in that?
Yeah. Yeah, for me, I mean, it all starts with the relationship, because you want a good working relationship with the client, obviously. And so the first year audits could be more challenging because there's more level work. You get 2 balance sheets you're dealing with. You're just kind of standing up policies and going through it for the first time. So there's that learning curve, and there's an investment that's being made, right, on both ends, to really kind of get the first set of financial statements and policies established. Going forward, it could vary company to company. It's funny because I'll see companies year 2, okay, great, it's a lot better and goes smoothly. We accelerate the timeline back up even a few more months and get the audit statements done. But then next year, the company's either doing another round of financing, they acquired a business. Tech companies, life science, they change so much year over year, right? So you can have the smoothest, easiest, kind of audit in year 2, then year 3, you're back to more challenges because of the growth, right? High growth environment, which for me, I've always enjoyed working in that space because it keeps me on my toes. It's never a dull moment. I really enjoy just the variety and the challenge that goes along with that. Also, turnover in team members, right? I mean, we all know we're only as good as our teams, really, at the end of the day. So obviously, if a controller leaves or a team member that's integral there one year and then not the other, that's another factor that's just going to play into being able to support the audit. So you want to start with the kind of the baseline audit and then build off of it. But the reality is, over time, there's so much other factors that play into it. And so for us, it's more about just communication. We try to do quarterly client service plan meetings with our clients. So it's some form or fashion. I know Eric likes to have his meeting on the golf course. So I just kind of know that. So, he likes to cover that there. So, it helps. And, it's obviously winter, it doesn't really work so much, but I know, there's a good spring touch point. It would be a good one. But so kind of periodically quarterly touch points with the team to make sure we're staying ahead of those issues. So Eric could say, hey, yeah, we're looking at this type of deal or transaction. Then I can go, okay, pull the broader team in as needed, stay ahead of that as well. And we want to know about it. We want to know about that transaction before it happens, because then we can say, hey, have you thought about this thing? Or have you, and we have experts and specialists we could pull in to kind of advise in certain areas where it's like, if especially if it's going to impact timing of revenue recognition, or there's just certain things that it's better to know in advance versus after the fact. Because if they're, obviously the business is going to do what the business is best for the business, but just from there's things that just knowing you can kind of head off any sort of potential issues.
Yeah, and maybe the same question for you, Eric, but for playing a good round of golf over time, how do you manage the process and relationship through subsequent audits?
Yeah, I do my best thinking on the golf course, so that's clear. I would say, over time, I think learning what's important, trying to learn. I think myself and the team, often a year one audit, there's a lot of learnings from that, things that, and an audit can also be not just a compliance exercise. It can also drive some operational improvement. So we found here at Blackthorn, some things that, policy wise came through. It's like, we've actually used this to better the business. We've gone through and documented this. So I think things over time, maybe year one, you have a lot of technical, lot of accounting for historic transactions. Year two and beyond, you're generally more proactive in the relationship, where you're talking about, timing of the audit, but you're not into the weeds on all the ins and outs, the big things that happen, and then maybe the future growth of the business, how things may progress. So I'd say the conversation gets a little bit higher level as time goes on.
That makes sense. Awesome. Shifting gears a little bit, as just a quick time check, we have another 10 or 15 minutes left. Want to leave some time for questions at the end, but shift gears into a rapid fire round for you guys. So shorter answers to the point. And we'll start with you, Kyle. I'd love to ask you, what are the most common misconceptions that your customers have about auditors, and how can these misconceptions impact an audit?
Yeah, I would think it's, we're auditors, we're independent, right? We got to do our job. At the same time, we're not out there to just play gotcha and find adjustments, and we definitely want to work with the company and set things up. And that's why one of the reasons why I've worked in a public company space, obviously different, kind of levels of standards, but I love the middle market space because you can be a little bit more collaborative in the bounds of the independence rules, right? And knowing the stage and the size and how the companies scale, again, you got this, there's black and white, there's some gray, but you want to get it right, and you want to be able to get there and be reasonable in how you work with the company as well. So our teams, we try to be very practical and try to be flexible as well and work with the company. And it's not always about just, well, you send me your answer and then, oh, it's wrong, gotcha. We're working together. It's a working relationship, and we're after, like I said, the same goal. The goal isn't to make this a painful process by any means, even though no one's probably super excited to go through their financial statement audit. It's not the lead in at my networking events that I love to tell people, and they super excited to chat with me. Hey, I'm an auditor, right? But no. So again, we like to work with our companies and make it so it's as smooth as possible, I guess.
Yeah, awesome, cool. Alex, actually, same one for you. If any other type, what are sort of biggest misconceptions that you've seen?
Yeah. I said this earlier with this group, but I feel like the audit can sometimes feel like a little bit of a black box until you've gone through your first one. And I do think a lot of people go into their first audits with a lot of hesitation. And I actually think that can hinder not only the productivity of the audit, but it can hinder the relationship. So you can clearly see Kyle and Eric get along really well. They've worked with each other for years now, and that goes a really long way. So being open, upfront, and honest with your auditors are going to be the same way, the other way around, will make it feel less like a black box, less scary, all those things. I, as an auditor, tried to be as approachable as possible, and I think that's how Kyle approaches his work as well. So we're really your friends. We're not trying to get you, even though I think broadly that's how the sentiment towards auditors. It's definitely not how it is in real life.
That's awesome insight. Thank you. Cool. Different questions for you, question for you, Eric. How do startups balance sort of the cost with quality when picking an auditor?
Yeah, it's a good question. Often cost will come up depending on what type of company, if it's, cost is always important. Oftentimes there's a misconception outside of the finance team, like, an audit's a commodity. We just got to get this done. What's the cheapest? Let's get it done. Not knowing how involved and how important it is. So we always do look at cost, but we also are looking for a firm that can work well within the team that we've got. And again, going back to that partnership. So, we definitely look at both, but get competitive bids, but we're looking for a kind of a balance of the cost and the quality, and specifically on running a small finance team, it's a lot of work. We're putting a lot onto the finance team that's already probably got too much on their plate. So trying to find a firm that we think we can run a smooth, high quality audit with and not be too disruptive to the businesses, and try to get a feel for that.
Awesome. Cool. Second last question for either you, Alex, or Kyle. Is there a documentation or process? We talked about high level, like what are the key areas, but is there a specific documentation or process that is most commonly overlooked by startups when they go through their audit?
I think Kyle and I will have the same answer, probably the 606 memo. That's definitely the most overlooked. And I think Eric touched on this too, of like, of course, you know how your business generates revenue and you know the contract structure and everything like that. Sometimes it lives in your head. Sometimes it lives on sticky notes, like on your computer. But it's typically not really just formally written down in how your contracts and how your revenue turns into journal entries. And so that transformation process definitely needs to be written down. It does not need to be anything fancy, but it definitely is something that you can pass off to your auditors for them to give a once over before they provide any notes. It just helps the auditor understand how you're already looking at the business before providing any of their own input. And Kyle, I don't know if you have anything else to add.
No, I 100% agree. The 606 side, and I think Eric mentioned it before. It's super helpful. You call it mini audit or a walkthrough of like, okay, you get the 606 memo, and that gives you a good understanding, but actually walking through just one transaction of here's the support we're looking for, and just walk us through kind of everything into all the way through the deferred revenue schedules and into the revenue. Just that helps, one, from just which we're going to make samples on that, but two, just to understand how it all works and here are the contracts and the clauses. And then when you're reading the memo, making sure it's all got to align, right? And then sometimes what ends up happening is you get in there and you're like, oh, actually, what is this one item? Well, it's a separate performance obligation. Oh, well, that's not really addressed in the memo. And again, so that's why it's kind of it's an iterative process to make sure we're understanding, but then you get it kind of laid out. And then that document's super important going forward, because onboard new team members just say, hey, read this, and it evolves over time as new product offerings come into play, new revenue streams. You kind of have several different kind of 606 for each kind of main, revenue stream. So it's super helpful from a team standpoint, continuity, as well as supporting the audit.
And just adding one thing on the 606 documentation, agree that's a big one, but from a finance lead, it can be used internally as well to drive some alignment with sales. Oftentimes, depending on who's leading the sales, you could have contracts in a wide array. You can have some very creative contracts being drafted. I think being that there's an audit in place, the company's 606 compliant is a good way for finance to drive consistency down to the organization. So there is a business benefit as well, while allowing flexibility for sales to close deals, but not having 10 different contracts with 10 different structures. That gets really problematic.
Yeah, that's a great point.
Yeah, cool. Awesome. Last one, a fun one, maybe for you, Kyle. What is the wildest thing that you've seen someone to try to slide by with in an audit?
Oh man, I don't know. That's a good one. Actually, I don't know if ones that I could share. Nothing super, like nothing crazy. I've never encountered like anything crazy, fraud related or anything like that. I mean, there's been situations where honestly, probably the most challenging one that I had to work through was a company that was literally just unauditable. Like we had to disengage, as in the records were just, there was not enough evidence to be able to support the financial statement audit. And we were doing a multiple-year audit, and there was a lot of different factors, but again, it was kind of like a worst case scenario, because you start going through it, you scope it, agree on the timeline, you start working through it, and then you get to these areas where it's like there's no support. And some of these were challenging kind of estimate areas as well. And the company just didn't even keep the POs and the contracts and just just the records, right? And so it's one thing, yeah, here's the bank statements, but the underlying records to be able to support the opinion just weren't there. So that was, for me, it was one of the most, because it involved, and we never want to disengage as a firm, because you have an agreement, you're going to work through things. But when you get into a situation where it's so challenging, and there's probably some other risk factors in there, I don't need to go on this call, but that led to us to saying, hey, we're just going to, we have to walk away. And it was an unfortunate situation. It was tough to work through, but I learned from that myself too, to be able to try to flush those things out further in advance and be more realistic and practical, saying, are you really ready? I know you have a tight timeline, but I know there's a lot of pressure for whatever reason, but can you actually be audited, right? I mean, that's kind of one that jumped out at me.
Yep. Cool. Awesome. Thank you for sharing. We have just 2 or 3 minutes left for questions if people want to add. I weaved most of the questions, I think, in naturally in the conversation. So most of them, hopefully, we've addressed. Any additional ones post. There's one that I didn't manage to sort of touch on so far, that for any of you, what stage of funding by letter, basically? Elsa asked about, like, do you most commonly see investors requiring audits?
I think it's B. It's either right before or right after the Series B. It's most common. Some investors, they'll let it slide to the Series C. Others, we've had to jump in on A round. But I would say general rule is kind of a Series B.
Cool. Awesome. Thank you. Yeah. Unless there's any other questions from the audience, I just want to give people a second, but then I'd say thank you guys so much. It was really engaging, really interesting. So again, your auditor is your friend. It's a true trusted partner. Forget all the misconceptions. Be ready. Get ready as well. Eric mentioned there's a fair bit of time to work through an audit with especially small teams. But again, if you have that trusted relationship, you can work through it. So thank you very much, Eric, Kyle, as well as Alex, for your time.
Awesome. Thanks, everyone.
Cool and awesome. Thank you, everybody, for dialing in.